Well, for more, I'm joined live by Michell over at FIIG Securities. Simon, thanks so much for joining us. These comments from Dudley, I mean, they certainly would have had quite a bearing on the market on Friday. I mean, do you agree with some of those comments that we really shouldn't be talking about negative interest rates at the moment, that the US economy does actually have some pretty good, strong momentum?
Morning, Leanne. Well, goodness gracious, a couple of months and we've got the US now talking about negative interest rates. So, look, it's interesting. If you have a look at the US Treasury curve, or US Treasury rates from sort of 2 years out to 30 years, that's down about half a percent from when they tightened back in December. So the market has certainly pushed those rates lower over that time, and now we have US Fed members having to come out and dismiss the possibility of negative interest rates in a tightening cycle. So very interesting. I think that's largely driven obviously by what we've seen in Japan, with the Bank of Japan moving in a negative, and we're expecting further action from the ECB as well.
I guess, you know, there's been a lot of talk about this recession potentially happening in the United States. We did, however, on Friday see better than expected retail sales data coming through, which certainly, I guess, helped to calm some of that exaggerated talk about that recession. How much did that add, those retail sales? I mean, how much did that add to those interest rate moves? You mentioned that rebound there from last week's lows.
Look, I think it was definitely the key driver was retail sales. I think add on to that the jump in the oil price we saw as well. That took a little bit of pressure off and drove a more positive sentiment, especially across more risky assets. But you know, that US yield curve, that Treasury curve again, you know, reached a low of around about 0.25% above the low it reached post the GFC. So, you know, we're down at the lowest levels we've seen post the GFC, and that's not a good sign. And I think that's why we're starting to hear this talk about recession. I don't think we're anywhere near that. I think we've got very positive, some positive trends in the US, but I think the challenge for them is, you know, being in a tightening cycle when you've got the rest of the globe working against you and making that even more difficult by continuing to lower rates, putting a lot of pressure on the US dollar.
Speaking of, I guess, pressure, Mario Draghi, I mean, it's really going to be a central bank focus this week, isn't it? And we know that markets really have been responding, I guess, or paying so much attention to what these central banks have to say. Mario Draghi speaking out tonight, I believe. Is he expected to really feed those market expectations that we'll see the ECB easing policy in March?
Look, I think he's got quite a task, Leanne, especially considering the volatility we saw also in bank equity prices, European bank equity prices last week, and some of the widening in spreads we saw on some European sovereign issuers, some of the European governments over there. So it's a bigger issue now than just you know, further possible ECB bond buying action, for example, extending the package, increasing the volume. You know, Mario Draghi did come out at the beginning of the year when we saw this volatility and said, you know, the ECB will look to add further support if needed. That was flying on the back of a commentary in December, just in the lead up to when we saw that US Fed move, where he said he was pretty happy and we didn't see any further measures come out. So, you know, big turnaround there in Europe, where I think the market will be expecting some further moves by Mario Draghi, some further commentary, because they are starting to lose a little bit of faith in the ongoing, you know, we'll do everything it takes, and that was reflected in the deterioration we saw last week.
Well, speaking of central banks, we have FOMC minutes due out, I believe, Wednesday across in the US, but of course RBA minutes due out tomorrow here locally. Been hearing recently from Glenn Stevens, basically, I guess, reassuring that we are seeing gradual improvement in our local economy. Do you think we're likely to see any clues, I guess, as to whether that easing bias is likely to translate into an easing anytime soon?
Look, interesting, Leanne. I mean, we saw Glenn Stevens at a parliamentary committee on Friday, so we got a little bit of an idea of what he's thinking, and he very much stuck to message there. I think, you know, while the market's certainly building in the possibility of further rate cut, given the global environment at the moment, I think it's very prudent for the RBA to continue to note that should it be required, they will follow other central banks and lower rates. Having said that, I think that we are seeing some good positive trends in the Australian economy, especially in that transition from a high mining capex into more sort of consumer growth. You know, there's some positive trends there. Employment is looking quite good. So I think the RBA is happy to sort of sit back and let the rest of the world work it out, and just sit quietly and wait and see what we get from the US, what we get from the ECB. But I think everything's looking pretty good for the Aussie at the moment.
Yeah, certainly a good thing. All right, Simon, we'll leave it there. Thanks so much for joining us.
Have a lovely day, Leanne. Thank you.